Hi everybody, in this class we are going to go over cash flow estimation, risk analysis, and then we are going to look at optimal capital structure as well. Now I'm going to start with one example, which the example pretty much clarifies everything that you need to know how we are going to do cash flow estimation, how we are going to accept or reject a given project. So in this particular project, the equipment is costing us $200,000, and then there is an additional shipping and installation cost of $40,000. We have changes in net operating working capital. It's increasing by $25,000, and it's decreasing by $5,000 accounts payable. So the net change in operating working capital is $20,000 increase. And then we have effects on operations. The new sales is 100,000 units per year at $2 per unit. Variable cost is 60% of sales. The life of the project is for 4 years. Depreciable life is modified accelerated cost recovery system, 3-year class. Salvage value is 25,000. In addition, we are given the tax rate 40%. Weighted average cost of capital for the firm is 10%. First, what we are going to do is we are going to map it on a project line, on a timeline, and then we are going to estimate the cash flows, the initial layouts, the estimated cash flows for years 1, 2, and 3, and then the terminal value, the year 4 cash flow, and whatever we are going to do to finish the project, terminal cash flows. Now let's start with year 0. For now, what we need to do is increase inventories by 25,000, increase accounts payable by 5,000. Net change in working capital is, as I mentioned, $20,000. So initial year, what you need to do is capital outlays is you need to come up with $200,000. Another $40,000 for installation. So your capital expenditures is $240,000. And then you have change net operating working capital. It's $20,000, just like we calculated here. Free cash flow in year 0 is the sum of these two, which is we need to come up with $260,000. It's a cash outflow, $260,000. Then we are going to calculate the annual depreciation expense. It is modified accelerated cost recovery system. 3 years asset is depreciated over 4 years. If you look at the tables, the rates are given for this type, and our basis is $240,000. So we can calculate the depreciation expense by using max system. Now we know that the depreciation expense, let's go over the project operating cash flows. We said our revenues are going to be 200,000. Operating cost is 60% of those, and then we have an additional depreciation expense of 79.2 thousand. Our earnings before interest and tax is basically 0.8, and it's $800. Tax is at 40%, $320. And then we have earnings before interest and taxes multiplied by 1 minus the tax rate is around 500,000, 480 to be specific. We are adding depreciation back. It's a non-cash item. So cash flow to the business is going to be $79,700. For year 2, we have pretty much the same figures, except the depreciation expense is changing based on max table right here. Again, this is a given table. If you tell me 3-year depreciable assets over max, then we are going to use this convention basically. Now in year 4, in addition to what we have as operating, we have a terminal cash flows, we have a salvage value of 25,000, and then we have tax on salvage value at 40%. After tax salvage value turns out to be $15,000. We are going to get our operating working capital back, which was 20,000. So terminal cash flow turns out to be $35,000. Now, our cash flow for year 4 turns out to be $89,700 if we take all these into account and then calculate the terminal cash flows too. Now, what we need to do is, after this point, we need to discount all these cash flows plus the terminal cash flow by 10% and compare it to the present value of initial cash outlay, which was $260,000. If the cash inflow is greater than, if the present value of the cash inflow is greater than $260,000, then we are going to accept the project, and if it's less than that, then we are going to reject the project. Some key notes that I want to underline for this is whether financing effects should be included in cash flows, like dividends, the interest expense you are paying, etc. And the answer is no. Financing effects are already accounted for in weighted average cost of capital, so you should not include the financing effects. Should a $50,000 improvement cost from previous year be included in the analysis? The answer is no. It's not going to affect the current decision. It was made last year and it's a sunk cost, and it should not be considered. The decisions we are making today is basically going to impact future, so we need to take into account future cash flows. If the facility could be leased for $25,000 per year, would this affect the analysis? The answer is yes. By accepting the project, the firm is foregoing $25,000. It's an opportunity cost. We need to calculate the after-tax opportunity cost, and it's going to be a negative cash flow. Basically, it's an opportunity cost, so we need to deduct that from our yearly cash flows. I again want to underline the fact that go over this example and make sure you understand this example. Once you understand the example, you are pretty much good to go with chapter 12. Last piece is, if you lay out the project's cash flows, as I mentioned, if I do the net present value, it turns out that it's a negative $4,000. The IRR is less than 10% WACC, 9.3. That's why NPV is negative. So we are going to reject the project. That's what we are getting. The return of the project is 9.3. The cost of the project is 10%. Since the return is lower than the cost, we are going to reject the project. Or NPV is negative, hence we are going to reject this particular project. With that, that is pretty much all I want to share with chapter 12, and let's go over chapter 14 right now. Okay, in chapter 14 we are going to talk about the optimal capital structure and how leverage, taking on debt, basically plays into the entire overall capital structure. I want to point out to you the very important slides on chapter 14. This, I think, is very important in the sense that it defines risk very well. If you look at two projects or two investments, their expected return is the same, but the pink one is said to be a higher risk than compared to the red one, and the reason for that is the chance of losing money which is the area under the pink curve, is higher than the chance of losing money under the red curve, the area right here. So that's why it is said that, you know, in this particular case, the spread or the sigma is kind of determining the risk. Later in the course, we are going to see that it's not only the individual sigma, but the combination to the portfolio or contribution to the portfolio that is playing into the game. But for now, that's all we need to know. What determines those types of risk? It's basically competition, uncertainty about demand and prices, about costs, the product relevance or irrelevance, foreign risk exposure, foreign exchange risk exposure, operating leverage are all different types of risks that can spread this curve, if you will, and make its basically standard deviation higher. So all these risks are contributing to that. Financial leverage or financial risk, on the other hand, is a narrower description in the sense that as you are taking on more debt, assume initially you don't have any debt and you are increasing your debt step by step. What's going to happen is you will be increasing your financial risk. You will be increasing your risk to pay your interest payments as you increase your debt, and at the same time you are going to obviously increase your risk of default, which is a big risk for common stockholders, because in the case of default, the stockholders will not get any money out, or very less, if any. Now, financial risk again is more debt. It's more financial risk basically, and that is going to determine how we are going to look at the capital structure ratio. How much debt should we take on? The balance there is, if you look at it, as we borrow more, the interest rate that the market will demand from us is going to increase. That's no surprise, in the sense that you are getting more leverage, you are taking on more and more debt, your credit rating and hence your credit rating is decreasing, and hence your riskiness is increasing. As your risk of your company increases, the debt that the market is going to require from you is going to increase as well. Now, we are looking at the return on debt before tax, and then let's take a look at the scenario where we are going to analyze basically the return on stock or return on equity, the demanded equity, as we increase the debt. As we increase the debt, and there is a whole Hamada equation that we need to you can go through, but the gist of this is, as you borrow more debt, the market will demand more return on the equity as well. So not only is the market demanding more return on your debt, but the market is also demanding more on your equity as well. Now the question is, if both are increasing, why don't the firms keep the capital structure at zero? And the reason for that is, eventually the cost of debt is very low, and there is going to be an optimal point, as we are going to see in the next slide, where the increasing this lower debt is going to decrease your cost structure up to a certain point, and then it's going to increase again. Now, what do I mean by that? If you look at the amount borrowed at zero, there is no return demanded from debt, because debt is zero. All is demanded from the equity side. So our weighted average cost of capital is pretty much what is demanded for your equity, which is 12%. As we start borrowing, this lower cost return on debt comes into the mix, and as we know, it's increasing return on equity too. So weighted average cost of capital decreases to 11.55. Again, as we increase more debt, both the return demanded on equity and return demanded on debt is increasing. However, return on debt is a cheaper option at this point. So as we mix the cheaper option into the mix, we are getting a lower weighted average cost of capital. Same is true if we borrow even more. The weighted average cost of capital drops to 11.25. And then after that point, what we are seeing is both the return on stock as well as return on debt are increasing so fast after borrowing more, that the weighted average cost of capital starts increasing again. So there is a minimal point in weighted average cost of capital which corresponds to a highest point of the stock price, and that is somewhere in between borrowing nothing versus borrowing pretty much everything. So everything you can. So that lies in the middle. The curve is literally a U-shaped curve. The minimum weighted average cost of capital is somewhere in between with this particular example, and this is all you need to take from this chapter. Basically, weighted average cost of capital has an optimal point, a minimum point, and that determines the optimal capital budgeting, meaning optimal debt level and optimal equity level for the particular company.